Hello and welcome to another video by reitspro.com. I'm Gaurav Jain and we have a website called reitspro.com where you get lots and lots of insights on REITs and InvITs in India. It's a dedicated site for REIT and InvIT investing in India. You can connect with us by mail or WhatsApp or Telegram. Do subscribe to our channel so that you get lots more of content in the future, and our website has a lot of resources as displayed on the screen on the right. Do visit the same also. So today we come up with a very interesting topic of S.I.P for REIT and InvIT instruments. So S.I.P is systematic investment plans, and they are simple and time-tested mathematical models of equity where these may not work in case of REITs. This is what we'll discover. Do watch till the very end because it's an interesting video and it answers a lot of queries by people who feel that it's good to invest in REIT and InvIT instruments, and you can take your own conclusions on SIPs for REITs in that respect. So let's just take a case of first stocks, equity stocks. So let's say there's a stock A which gives the annual dividend of 1.25%, and there is a stock B which gives an annual dividend of 1.4%, which is a good 10% differential in dividends. Would you evaluate A or B based on dividends? Probably not, because there will be other factors you'll consider. So you will not consider the dividends as much, but you would consider the prices of the product and you would average with an SIP like this. So for example, if this is the line of the total return index, it's just a representative line, and you are investing on various times, and this is the yellow line which kind of averages your cost of purchase. So the cost of purchase would be averaged out in case of equity investing if you do SIPs. Now let's move on to the second part where you have NCTs or debt. Now let's say a debt of A type and a debt of type B. So there are two types of debt. Let's consider that it's all equal. The parameters are pretty equal in this. And in the first one, you get an interest of 12.5%, where in the second one, you are getting an interest of about 14%. So that's a good 10% differential. Now, considering that the risks are the same, you would definitely go for option B, considering other parameters are fine. Let's assume equal parameters here, right? So we would consider that we would invest in, probably our inclination would be more towards the B part, the B debt B type. Why do you think the choice differs here? Because you would naturally conclude that these are different products. Now, in this case, what happens if you do equity is like this, whereas in case of the debt part, you don't have a choice because you are considering the yield. You're not looking at the averaging of the price. Of course, there are strategies like laddering, etc., which are based on maturities and interest rates and so on. But the particular SIP concept which we follow in case of equities does not really work as well in REIT in case of debt. So when we talk about equity, we say that I don't see dividend. The company is growing with my money in case it doesn't give dividends, so it's reinvesting in it. And the product and service is also what I evaluate when I do equity investing, and the qualitative factors like management, etc. In debt, the basic criteria is when you evaluate yields and risk of capital. Of course, the timelines in terms of how the qualitatively the instrument would work for you, time commitment, liquidity, and so on. So the parameters of investing are different, and yield is a major focus along with the risks that you do take in debt. Whereas in equity, having these same parameters of yield and risk, you would still not give too much consideration to dividends, and you would give to other factors more. Now, why is there a different evaluation product in case of REITs? Because again, REITs is a hybrid product. REITs is somewhat like fixed income investing and somewhat like equity investing. So for REITs, if you really look at it, there could be price stability in movement, which is far greater than equity. There would be an asset base, which is hard assets underlying it. And in case of REITs, the major part is distributed, whereas in case of equities, a major part is plowed in. So that's a very major difference in case of REITs versus equities. Now let's take an example of REIT A versus or REIT B. Now In case of REIT A, suppose you have a yield of 10%, and in case of REIT B, you have a 12.5%. There's a 25% difference. What would you choose? Would you go by SIP for both? Do you feel that that would be the right thing to do? That take an SIP in both of them together? Or is there a difference in that understanding? So in case of REITs, there are lots of ways we do evaluation, which are, say, the distribution per unit or the NAV, revenue growth projections, addition of assets, macro outlook of the economy, and interest rates and rent and the movement in the economy. So these are various factors, but if you were just to simply understand from the point of view of SIPs versus REITs, we would probably like to take it down to two basic factors here. What is the percentage yield that you are expecting, and the growth prospects? If you consider these two primarily, you would get answers to most of your questions on whether I should do an SIP in REITs or not. So let's look at the three factors that you'll have to assess when you look at REITs. First is the yield, second is liquidity, and the third is risk. So in case of yield, you would really like to have a comparison as a debt feature. For example, you would compare with FDs or some other NCDs and so on, because you would be getting regular returns and more or less fixed in nature. The second is the liquidity factor. In a lot of instruments, debt instruments, there are times when you have to put in your money for a particular point of time. So there are different maturities for some instruments. In case of REITs, you can exit anytime. That's more of an equity feature and as per market price. The third is very important here, which is the risk, which is an equity feature where you will also evaluate, along with the yields, you will also evaluate the growth and returns and whether you are comfortable with the price fluctuations that happens in the underlying asset. So the growth of returns can happen, but over a much longer period in case of REITs, and there can be fluctuations in between. So this is something that one has to evaluate when gets to REITs, comparing it with both the debt and equity features of REITs, which are built into the instrument. And to add to it, there is something that every investor must factor in, is taxation. As an example, if a particular instrument is 90% tax free, which is one of the features of REITs, for example, Mindspace REIT has a lot of component tax free. So if you have a 90% tax free income and your bracket is 35%, so you will really have to do an alternate investing of an instrument which yields you 10% to reach the same level as the Mindspace REIT or something, or a comparable REIT which has a 90% tax-free income. So focus on growth is one of the key mantras for evaluating REITs. So your evaluation should also be very much on yield, and then second part we talked about is the growth prospects. So you'd say that number one slide which I'm presenting to you is about growth, is about investing in assets growing well over time. So you could evaluate REITs with respect to the quality of the assets that they have. And the same goes vice versa, that bad real estate or which does not have a future in locations which are more or less dead would not suit a REIT. Also, investing in assets which are depleting completely. For example, there are some InvITs which have finite lives, assets which have finite lives. Though InvITs themselves can undertake more assets, which we've explained in the other videos, but say if it has most assets which are depleting in 10 years time, say some road assets, then that risk has to be understood with respect to the growth part. The second slide I have here is, for example, the future of InvITs is really governed by the national monetization policy of the government. So the government expects to push in more and more assets into the pipeline, NMP pipeline, and there are 30,000 crore projects in construction stage, and that would take time. So you'll need to evaluate the kind of assets that would get into the InvITs if this pushes there. The third slide I have here is the REITs future. So you need to evaluate REITs in case of a rising Indian market and also factor the global environment. Today we have a very fluctuating global environment. Then the conclusion that we can come to here is that the SIP, if it goes in line with your yield expectations currently, has to be there. So the currently has to be very strong. You can't just rely on the future growth aspects only. So you need to assess currently mathematically. So it's a simple thing. What are you getting post tax versus what are the price? It's a very simple evaluation criteria. Unlike equities, these are fairly well explained valuations that are there in every REIT and InvIT. So you can have a look at what are the yields that are there. The second part is the mathematical model of S.I.P would really not be able to work here in case of REITs because of this factor. Now, the second main feature here is that the expectations of future of the company as well as the macro scenario both have to be looked at. This is a lot of equity like features. So in conclusion, SIPs may not work unless you understand this both yield and risk expectations at the same time. You cannot buy overvalued assets and at the same time not look at growth in future also. So that's the conclusion here as far as my understanding of SIPs is concerned. Do like and share the video. Thank you so much.